You got the raise. You worked hard for it. You negotiated. You stayed late. You proved yourself. And then the offer came. More money. Finally, you remember thinking, okay, this changes everything. This is the moment things start getting better. And then 3 months passed, and you checked your bank account, and it looked exactly the same as before. Same balance, same stress, same feeling of money slipping through your fingers before you even get a chance to breathe. The raise was real. The extra money showed up in your paycheck, but somehow, some way, it disappeared just as fast as it arrived. If that sounds familiar, you are not alone. And you are not bad with money. You are caught in something that most people never even realize exists. It is called the salary trap. And today, I am going to show you exactly how it works, who benefits from it, and most importantly, how to escape it before it costs you another decade of your life. Before we get into this, if nobody has ever taught you this stuff, that is exactly why this channel exists. Hit subscribe and turn on notifications because every week we break down the money rules they never taught you in school. Let us start with something uncomfortable. The system you are working inside was not designed to make you rich. It was designed to keep you productive. There is a difference, a very big difference, and once you see it, you cannot unsee it. Here is how it works. You start your career making $30,000 a year. Life is tight but manageable. You learn to live on $30,000. Every dollar has a purpose. Then you get a raise to $40,000. And something happens that nobody warns you about. Your lifestyle quietly expands to match the new income. A slightly nicer apartment, a newer car, eating out a little more often. Nothing dramatic. Just small upgrades that feel completely reasonable because you are earning more now. You deserve it. But here is the problem. Those small upgrades lock in permanently. The nicer apartment is now your standard. The car payment is now a fixed expense. The eating out is now just how you live. So when the next raise comes and you go from 40 to 50,000, the same thing happens again. Lifestyle expands, expenses lock in, and you end up feeling just as tight at 50,000 as you did at 30,000. This is called lifestyle creep, and it is the silent killer of every raise you will ever receive. Researchers call this the hedonic treadmill, the idea that human beings quickly adapt to improvements in their circumstances and return to a baseline level of satisfaction. In plain language, it means you get used to having more, and it stops feeling like more very quickly. So you need even more to feel the same way. And the cycle never ends. But lifestyle creep is only part of the problem. Let us talk about the part that nobody in your company HR department is going to explain to you. Taxes. When you earn more money, you pay more taxes. Not just more dollars, but a higher percentage. This is called progressive taxation. In the United States, if you earn up to $44,000 a year, you are in the 22% tax bracket. But if you get a raise and cross into the next bracket, that additional income gets taxed at 24%, then 32%, then 35%. So imagine you are earning $60,000 and you get a $10,000 raise. You do not get $10,000. After federal income tax, state tax, Social Security, and Medicare, you might actually take home $5,500 of that $10,000 raise. The government quietly takes almost half of every raise you earn above a certain threshold, and nobody tells you this when they hand you the congratulations email. Now add lifestyle creep on top of the tax hit. You got a $10,000 raise. You took home $5,500. And your lifestyle quietly expanded by at least $4,000 a year because of the nicer coffee, the upgraded subscriptions, the slightly better version of everything. You are left with $1,500 of actual financial progress from a $10,000 raise. $1,500. Split across 12 months, that is $125 a month. That is the salary trap. You work harder, you earn more, the system takes its cut, your lifestyle takes its cut, and you end up almost exactly where you started. But it gets deeper than this. Let us talk about who is actually getting rich from your labor. Every day you go to work, you are generating value. Real, measurable, economic value. The products you build, the customers you serve, the problems you solve. That value is worth far more than your salary. It has to be. Otherwise, your employer would not be in business. The entire model of employment is built on the gap between what you produce and what you are paid. That gap is called profit, and it flows to the top. A study by the Economic Policy Institute found that CEO compensation has grown over 1,300% since 1978. Worker compensation over the same period grew just 18%. So while you got 18% richer over 40 years, the people at the top got 1,300% richer. From the same economy, from the same companies, often from the work of the same employees. This is not a conspiracy. It is just math. And the math explains why your boss can sit back relaxed while you grind at your desk. Because the system was designed exactly that way. Now here is where most people make the biggest mistake. They think the answer is to earn more, get a bigger salary, find a better job, negotiate harder. And while earning more is not bad advice, it completely misses the actual problem. Because if the trap is in how the system processes your money, then earning more just means more money going through the same broken system. More lifestyle creep, more taxes, more gap between what you produce and what you keep. The real answer is not to earn more inside the trap. The real answer is to understand the trap well enough to build something outside of it. Let me explain what that actually means. There are two types of income. Active income and passive income. Active income is what you earn by trading your time for money. Your salary, your hourly wage. Every dollar you earn requires an hour of your life. When you stop working, the money stops coming. Passive income is money that works without you. Investments, rental income, businesses that run without your daily involvement, royalties. Every dollar of passive income you build is a dollar that does not require your time. And unlike your salary, passive income does not get trapped in the same way. It does not trigger lifestyle creep because it shows up quietly in the background. It does not always get taxed at the same rates as earned income. And it does not require you to be physically present to keep earning. The people sitting in the big chairs with the cash stacks around them are not getting rich from their salaries. They are getting rich from ownership, from assets, from passive income streams that compound over time while they sleep. This is the fundamental difference between employees and owners. Employees trade time for money. Owners put money to work so it makes more money. Now, I am not telling you to quit your job tomorrow. Your salary is actually a powerful tool if you use it correctly. The problem is that most people use their salary to fund a lifestyle. The financially smart move is to use your salary to buy assets that generate passive income. Then use that passive income to fund your lifestyle. In that order. Let me give you a concrete example. Say you earn $50,000 a year. After taxes, you take home roughly $38,000. Most people spend $37,000 and save $1,000. That is the average American savings pattern. $1,000 sitting in a traditional savings account earning almost nothing. Now imagine instead you automate $500 a month into an index fund the moment your paycheck lands. Before the lifestyle creep can get to it. Before the unnecessary subscriptions. Before the impulse purchases. That $500 per month invested consistently at a historical average return of 10% becomes over $1 million in 30 years. $1 million. from $500 a month out of a $50,000 salary. But here is the key insight. Most people wait until they feel financially comfortable before they start investing. And they never feel comfortable. Because comfort is a moving target. The lifestyle always expands to consume whatever is available. You have to invest first and live on what is left. Not live first and invest what is left. Because what is left is always nothing. This is called paying yourself first. And it is the single most powerful habit that separates people who escape the salary trap from people who stay in it for their entire working lives. Here is your practical plan to start escaping the salary trap right now. Step 1. Calculate your real hourly rate. Take your annual salary, divide it by 2,000 working hours per year. That is your hourly rate. Now, every time you are about to spend money, convert it into hours of your life. A $200 dinner is not $200. It is 3 or 4 hours of your life. Does this purchase deserve that many hours? Sometimes yes. Often no. This simple mental shift changes how you think about every spending decision. Step 2. Find your lifestyle creep. Go through your bank statements from 12 months ago and compare them to today. Where did the extra money go? Subscriptions you do not use. A more expensive car. Meals out instead of cooking. You do not need to eliminate everything. Just identify the 2 or 3 biggest lifestyle upgrades that happened automatically after your last raise and decide if they are actually worth it. Step 3. Create a gap between earning and spending. Every raise you get going forward, save at least 50% of it before your lifestyle can adjust. If you get a $5,000 annual raise, that is approximately $250 more per month after taxes. Immediately automate $200 of that into investments. Your lifestyle never even knows the extra money existed. This is how you make financial progress without feeling the pain of cutting back. Step 4. Start building one passive income stream. It does not need to be huge. It does not need to replace your salary tomorrow. Index funds. A small rental property. Dividend stocks. A side project that generates income. The point is to start. Every dollar of passive income you build is a dollar that is working outside the salary trap. And over time, those dollars compound into something that actually changes your life. The salary trap is real, it is powerful, and it is designed to be invisible. Most people spend their entire careers inside it, always feeling like they are almost there, always feeling like the next raise will finally be the one that fixes everything. It never is, because the trap moves with you. But now you see it, and seeing it is the first step to escaping it. Your salary is not your enemy. It is actually your most powerful financial tool. But only if you use it to build assets instead of fund a lifestyle. Only if you pay yourself first. Only if you treat every raise as an opportunity to widen the gap between what you earn and what you spend. The people getting rich are not necessarily earning more than you. They are just using the same money differently. They are building outside the trap while everyone else is running harder inside it. So the question is not how do I earn more? The question is, what am I building with what I already have? Because that question and your answer to it is what determines everything. Start today, not next raise, not next year. Today. Because the salary trap does not take days off. And neither should your plan to escape it